Good afternoon. My name is David Auerbach, back for another exciting REIT webinar. Today we are joined by the REIT management team at BlackRock. BlackRock, a very small organization. Um, we have their nice little disclaimer that compliance has asked us to share. So we have it up on the screen here for compliance purposes. As you're reading this, I do want to mention that we will not be talking single stock names today. This is going to be more of a sector overview, macro view piece. So single stock questions, I'm sure you can reach out to our speakers directly. But on this webinar, we will not be talking about individual names today per BlackRock's compliance. For those that don't know, BlackRock manages $291 billion approximately of infrastructure and real estate assets, $10 billion of listed real assets and equity securities. Our speakers are on the active side. For folks that follow BlackRock, you might be familiar with their suite of passive ETF products. They won't mention the tickers, but I'm more than happy to. Most famously known as IYR, RES, REZ. Those are probably two of their flagship funds that you might have heard of before. A little bit about our speakers. Raj Rehan is the head of real estate securities. He was also way back in the day at Aviva. I remember covering Aviva back in my Green Street days. And with his wonderful accent, grew up in London, got his BSc degree in economics from the University of Warwick. Needless to say, Raj is a very smart cookie. But so is our other speaker, Curtis, my old buddy Curtis Yee. I can't believe that you've been around for, gosh, Curtis, over 20 years now. Wow. Yeah, because you and I used to talk when you were back at your GIC days way back in the day. That's right. So
That's right.
GIC, Government of Singapore, Brookfield, UIUC, graduate there. So guys, thank you so much for joining us. Real quick, here's a brief overview of the topics that we will be discussing today. I'm most curious about question one. What is BlackRock and how do you guys do your thing? We'll talk about why listed REITs. We'll look at public versus private, looking at performance, the macro situation, interest rates, tariffs, oil, inflation, the conflict overseas, that dreaded two-letter word, AI. We'll look at some various sector outlooks and themes and also talk about all the capital markets activity, especially looking at the M&A activity in the sector. And then lastly, we'll cap it off with some audience Q&A, should anybody like to join. So with that, let me turn off the share. Guys, it's funny. We're in a different situation today than when we spoke just a couple of days ago, because it seems like right now it's frankly risk back on. We have this tiny IPO pricing here in a couple of hours that one side of your firm is involved with, obviously not on the active real estate side, although that would be pretty sweet if we could somehow get SpaceX into the REIT portfolio. But let's kick it off. What do you guys do at BlackRock? Because when I think of BlackRock, I think of the ETF side of the business. And I know we're not talking about the passive, but you guys focus on the active portfolio. So walk us through what that means. Top down, bottom up. How do you do your stock selection? What's the ideal sweet spot of a portfolio? Is it 20 names? Is it 50 names? Is it 500 names? Like walk somebody through who may not know how BlackRock does its thing so they could potentially take a look at you guys.
Yeah, no, I can kick off there. And thank you, David, for having us. It's a real pleasure. I think certainly, I think in the two of us, you have long-time listeners, first-time callers, but really excited to be here and be here with the audience, and very much value the relationship that we have with you, and would love to develop one with anyone in the audience that wants to get in touch. And I'd also just want to kind of give you a shout out, David. I think what you do for our industry, what you do for our community, as kind of the public real estate world, the real estate world as a whole, is pretty awesome. And so, kind of kudos, congrats on like what you've built. Yeah, just by way of introduction, as you kind of did, Curtis and I are co-portfolio managers on BlackRock's active real estate platform. But clearly, we, and I think we had it in one of the slides, our real estate and infrastructure business that we're portfolio managers across is 10 billion of assets. Our kind of real estate portion of that is 8. But BlackRock as a firm own a lot more than just $8 billion of the REIT market, right? I think the number is, I don't think it's necessarily disclosed, but you add it all up and piece things together, it's comfortably north of $100 billion of kind of REIT ownership that the firm has. And as with most big organizations, if you look at a firm like ours or a firm like the big banks, a JP Morgan, a Meta, like pick your industry, there are big operators out there, and it's often quite hard to really know exactly what's going on and piece it together from the inside. So happy to spend a bit of time with you guys and kind of share what we do and how we fit into the big puzzle. So there are both passive and active strategies on the equity side, but it's also important to recognize that as a firm, we're also active across the capital structure of the real estate markets, right? So, you'll see, again, a lot of our focus, and perhaps people in the audience are focused on the public real estate markets, where you'll see BlackRock as, number 1 and number 2 on the register, where, Curtis and I, our focus is on trying to pick the right stock within our world. And to do that, we leverage a number of our colleagues across the other parts of the capital stack, right? The private equity strategies, the private debt strategies, and the public credit strategies. We're also one of the biggest investors, or the firm is one of the biggest investors across the CMBS market. Curtis and I are kind of on at least a couple of times a week, we'll be on the phone or virtually, virtual call or go downstairs and go and drop in on the CMBS guys and see what they're seeing, right? Like, the two markets often do move in different ways at different time frames, and that, for us at least, offers us active opportunities. But I think your question was, hey, like, how you guys set up what you do. Our job is we have $8 billion in REITs. Our clients are allocating that capital to us to deliver alpha to the benchmark, right? This isn't an index tracking strategy. It's, hey, we like the beta of REITs, but hey, you guys go and give me alpha on top of that. And that's what we focus on. The indices, the passive funds are obviously, they're big in assets. They're also big by number, right? They hold every single company in the index. We'll typically own 30 to 35 stocks, right? So much more concentrated positions. And, the two of us, we have 2 colleagues, 2 awesome colleagues that make 4 investors in the US that focus on the US REIT markets. And between the 4 of us, we divide up the universe, we divide it up by property type. We seek to be experts in these industries, kind of seek to be embedded in these industries. We're fortunate at times that people in these industries call on us to kind of share, speak at lodging conferences or data center conferences to share our views. It's not, it's every now and again, it's not all the time, but we seek to ultimately embed ourselves in our sub industries, such that, again, we know what the right stocks are to pick.
And you said that you're only domestic, not global. Is that correct?
Sorry, we that 8 that I referenced include all of our REIT strategies, which are both US and global. Of that 8, around 5 sits in the US. But yeah, we both sit here in New York, typically next to each other. We're in 2 different rooms right now, but that was just for the cameras. So our focus, our day-to-day focus is the U.S. markets, but we certainly, feed into our broader global strategies as well.
Raj, you don't have to cover for Curtis. We both know he's home nursing a major hangover after last night's Knicks' miraculous last-second tip-in victory. But that's okay.
No lie. This is for hydration.
Unbelievable.
Congrats to your Knicks. Me as a Fish fan who goes to a lot of shows at Madison Square Garden, I can't imagine how electric it's going to be on Saturday. Anyways, back to the real world. So we just came back from NAREIT. And a big topic at the NAREIT level at the leadership meetings, and Raj, I think you could say that it's been this topic for the past 20 years, frankly, is listed versus private. The disparity between private real estate pricing and where public REITs stand. Why investors should be looking at public traded REITs today versus all the headlines that we're seeing in the world of private. We could spend an hour alone on public versus private. But from where you sit, because you guys technically straddle both sides of the wall, why listed REITs in today's environment?
Yeah, David, so I'll hop in here and just touch on that. And so I think it's worth just taking a step back and like, what are you buying when you're buying a liquid, when you're buying a listed REIT? In our view, REITs are a liquid proxy for the underlying physical assets. So functionally speaking, the assets you're getting exposure to when you buy a listed REIT is really no different than what you're getting when you buy the private markets from an asset level. In fact, both, when you look at the data, when you looked at our lived experience, what we see is that both the values and the returns between the public and private real estate markets tend to converge once you get past, the short-term volatility that exists in the public universe. But that said, there are a few key differences between listed and unlisted real estate. The first one is that listed real estate provides access to many of the growth sectors at scale. So when we look at our various indices and benchmarks, what you're buying into is really access to, we call it the house of the modern economy. So if you look at like the different subsector compositions of what we invest in, it's no coincidence that the two largest growth sectors in our economy, which is healthcare and technology, also are the two largest sectors in the US REIT land, right? And you contrast that to many of the traditional private real estate offerings that focus on, the traditional core four subsectors of apartments, industrial, office, and retail. I think we would argue that your opportunity set in the listed sector is more favorable as a starting point. Listed real estate also offers liquidity, diversification, transparency, world-class management teams, and governance structures that I think in most cases are well aligned with shareholders. Stock returns are generally a pretty decent mechanism for enforcing good behavior. And so we've seen that take place in our asset class, such that most of the stocks that you can buy today are structured, with pretty good alignment. The trade-off against private real estate is that we're not in a control position, right? We're not the GP. And so where we try to create value is by allocating to, the best management teams, the strongest platforms, to sectors and markets with the strongest fundamental outlook, and in really seeking out mispriced, underappreciated real estate opportunities. And I think one final differentiator that is often underappreciated is that liquid REITs can essentially monetize their multiple. And what I mean by that is that when our companies are trading at a discount to the underlying value of their assets, they can sell assets at market value, and then they can buy back their stock at a discount. And that's like pure arbitrage, right? So we've seen more buyback activity this year than I can really recall ever before, because there's a number of subsectors that are trading at significant discounts to private market values. But the reverse is also true. When REITs are trading at a premium valuation, they can raise capital at attractive terms, and they can deploy those proceeds to spread invest and grow, oftentimes resulting in significant earnings and value accretion. You contrast that to private real estate, which generally has issue equity or capital at par value. And it's a pretty different dynamic that way.
Raj, you got anything there?
No, I think, it's that last point, right? What have you seen this year? You've seen apartment companies sell and buy back stock. I was about to name a ticker, and but compliance just buzzed me. So tell me not to. But yeah, I think
I will say it. It was Avalon Bay and Equity Residential, AVB and EQ. Go ahead.
I was actually thinking the other one. I was thinking the Southern California portfolio. Anyway, so you've got, as Curtis described, when you've got sectors like the apartment sector trading at a discount, they sell portfolios and they've been buying back stock and been pretty active on it. In contrast, healthcare, we've seen 2 IPOs, data centers, we've seen 1 IPO this year, and there's more to come. Significant issuance, and then other sectors when they are issuing on their ATM programs and going out and acquiring assets, and that's a unique thing in the public real estate markets that really doesn't exist in private or in many other sectors of the market. And so it's a big advantage of our world.
So it's interesting you raised that point. On my right here on my screen, Andy Power, the CEO of Digital Realty Trust, is being interviewed. And when you started talking about the core bread buckets, if you think about our core days, back in the government of Singapore days, back in the Aviva days, there was no digital realty. Towers, infrastructure, data centers, that type of stuff didn't exist. Now we have 20 subsectors that make up our industry, and that number continues to grow. I want to say one more thing, because you both mentioned it a couple of different times. I had dinner with one of my former board members last week at the conference, and he goes, Dave, I'm going to play a game with you, okay? What's the number 1 rule of real estate? Curtis, what's the number 1 rule of real estate?
Location, location, location.
What's the number 1 rule of REITs?
Location, location, location.
Location, location, management. Management. So you guys have both hit that button there about how important management is running this ship. So kudos. Okay, so great day to have this conversation. Would have been different this morning versus this afternoon, obviously. But right now, REIT industry is popping. We're getting back close to 1,500 on the RMZ index. Let's go. Talk to us about performance year to date. What are you guys seeing from where you sit, performance year to date?
Yeah, no, I mean it's been many years in the coming. We've had a rough number of years, right? And it has been a nice change of environment to see our sector up and actually outperforming the broader market. And I think there are a number of kind of dynamics and kind of factors behind that. One of which is that we are coming from a position of having lagged other sectors across the equity markets for a material period of time and by a long way. And so we came into this year looking very cheap. And there's a natural valuation catch up that is still, there's still room to run in terms of where we trade today across a number of different valuation metrics relative to where a kind of rational approach would say that we should trade. Equally, so we, Curtis and I and our broader team, we're real estate through and through, a REIT through and through, but we're not permabulls, right? We have not spent the last 20 years of our career telling people to always buy REITs and buy more REITs. And, we're not permabulls. That's just not who we are. We're analysts. We're investors. We try to keep ourselves honest and keep each other honest. But we have been particularly bullish on the REIT sector for the last 18 months. And the reason for that, one of the key cruxes of our thesis has actually been around growth. That we expect to see an acceleration in earnings growth from now and back at the beginning of 25 and 24 into the end of this decade, right? A multi-year run of an acceleration in earnings growth that is going to be driven by an acceleration in market rental growth that is driven by what we see is as a structural impediment to supply. And people talk a lot and point to the numbers of, hey, we've got construction starts are coming down, and look, that's going to bring supply down, and that'll be good, demand supply. It's like, yes, we come to the same conclusion, but we actually build it up from like a first principles approach, and we're not unique, but I think it is. We prefer to frame it in this way, in that you put yourself in the shoe of a developer. Why is it that the developers are not constructing right now? One of those reasons is the developer is always going to want to develop, but they need to find somebody to give them money. And the capital allocator of today, whether it's the bank or an equity provider or somebody else, the oxygen has been taken out of the room by build in other parts of the economy, AI being the most notable. So capital allocators are looking elsewhere, and they've kind of forgotten our world of real estate. Interest rates obviously moved up, cost of capital has gone up. What does that do? They put that all into a mix. What does it mean? It means rents need to be a lot higher to entice that capital. And what we're seeing right here and now is that replacement cost like that. And what is that? What does that all boil into? It boils into a replacement cost rent. Replacement cost rents are materially above market rents. And we expect the economy ultimately to be resilient over time. Resilient demand, replacement cost rents materially above means that the building only gets built when market rents get to replacement cost rents. And that's going to drive spikes in rent at different times in different pockets of our house. But I think we've started to see it. New York City office rents doubled from the summer of 24 to the kind of spring of 25. And it doubled because the only way for, Deloitte took a building in Hudson Yards from Related. The only reason that building got built was Related charged them a rent that was double the rent next door that had been signed 18 months prior, so that they could go to their capital providers to then go and build the building. So we're bullish. Okay, it's been, sorry, to go back to the original question. We've had a good start to the outperformance against the broader market. There's a bit of catch up in there. There's a bit of, hey, like we've been a bit of a port of calm in a storm on a number of different fronts, geopolitical. You mentioned SpaceX earlier, kind of funding trades that, nobody's selling REITs to buy SpaceX, right? They're selling Mag 7. But there is a pretty good fundamental setup here, and we think it's kind of long. It's got a long way to go, and it's a multi-year trend.
Curtis, you got anything for us?
Yeah, just Dwayne, I think it's worth spending a little bit of time just on REITs this year. REITs are up and outperforming the broader equity market, even as interest rates on the longer end are also up, right? And so one of the questions that we often get is, aren't REITs just a bond proxy and they should go down when interest rates are up? And it is worth spending some time just kind of dispelling that myth a little bit. I think calling REITs a bond proxy is a little bit of a misnomer. It's misplaced, right? REITs are similar to bonds in that they often have contractual leases with duration, but ultimately we're a cyclical asset class. We grow with the economy, right? We are the house of the modern economy. It's also worth just noting that, especially in the US, one of the main transmission mechanisms of interest rates in the economy is through the housing sector. And so it's not surprising that home buying activity is depressed, but you could make the case that that is good for residential REITs. And the flip sides of being locked out of the market for so long, if you're a prospective home buyer, is that consumers are just spending what they would have, they were saving for their down payment on other uses instead. And so that's good for retail, it's good for industrial, it's good for lodging, and we're seeing that as well.
Look, no matter how much you slice and dice it with the REIT performance, and it's great, we'll take all the wins that we can get, but we're still underperforming the S&P by like 60% going back to 22 at this point. So we've been saying at Hoya, one of two things has to happen. Really three. REITs have to rally, S&P has to sell off, or some combination of both. What we've been seeing is almost what they say unprecedented. So it's nice to see us trading up. We got a long way still to go, it seems. All right, so Raj, you briefly started touching on the macro stuff. So let's get into it. We've got all sorts of macro things. We could take it one by one. We could pile the whole thing together. Interest rates, inflation, tariffs, although I think tariffs are out the window now. Oil prices, the conflict overseas. Frankly, we should talk about SpaceX and Anthropic and OpenAI, some of these massive IPOs that are coming here in the next quarter, because I think that is going to shake up. It doesn't impact us directly, but as you said, it's not like people are selling REITs to buy these deals, but in the same breath, there's a lot of these big mega deals that are coming versus the Janus Living IPO, the National Healthcare IPO, Fermi. We were not going to touch on Fermi. We'll leave Fermi. We'll save that for another day. But I guess putting on your REIT glasses, what do all of these macro things tell you about investment demand for our sector right now? I guess that's the easiest way to phrase it.
It's an easy way to phrase a really complex question, right? But yeah, no, I think we're in this, and I think we've been saying this for a little while now, a number of years, right? Like we are in this era of change, and everyone, everyone thinks this is the most uncertain time that you've ever operated in, and I disagree with that statement. I think the world is always uncertain. But I do think the world is changing in many ways and in many spheres, whether it's societal, geopolitical, technological. And as you live through change, one thing that I think makes us sleep a little better than at night relative to like some of our peers, even at the firm here, who manage investments in other sectors of the economy, is that the real estate market, it can be a blessing and a curse, right? It doesn't move that quickly. And so I think as these trends work their way through our world, we will have a little more time than others to kind of figure out and adapt, such that, in technology, if you're not an early mover, if you're too late to a trend, your business model is just decimated. I think in real estate, we will have more time to learn and make more informed decisions around that change. And there will not be that same penalty of waiting too late to adjust. But I think whether it's the whole concoction, right, of what you just described, right, the war, the implications on global trade, the implications on inflation, deglobalization, nearshoring, boosts real growth, likely inflationary. AI, what does AI do to the nature of society, the nature of knowledge work? What does that mean for artificial intelligence? Like, we've been making a statement for a little while now as well, like, hey, we want to be where artificial intelligence lives and works, not where human intelligence lives and works. Right, like we've kind of seen that in certain periods of the REIT market with the office and apartment REITs relative to the data center REITs. There is a lot going on out there, and I think we probably need longer than this, the time we have left to really get into it all. But the way I frame it is, I think it's a benefit of the real estate industry that we're going to have a bit more time relative to other sectors to really figure it all out. And ultimately, like, hey, it is our day jobs to like look to be on top of this stuff and be thoughtful around it, and we're doing it in we're trying to do it in a rational, kind of logical way, both bottom up, but also not losing the forest from the trees.
Curtis, I'll get to you in a sec. You make a good point, Raj, because the REITs have been operating in this high for long environment for several years at this point. Higher for longer is being kicked around on the news channels again. And the REIT management teams are like, what are you talking about? It's been high for long for several years. This is normal for us. We're operating. We're signing leases. Our earnings are up. Our dividends are up. We're doing fine in an elevated interest rate environment. So I feel like for a lot of these players, it's business as usual. Besides NAREIT, my personal favorite conference every year is the NYU REIT Symposium. I don't know if you guys have ever attended NYU. It's the best one-day REIT event of the entire year. The reason I mention this, I'm not going to say who the CEO was, but this goes back to the time of tariffs a couple of years ago. And it was like a T+1, like right as tariffs were happening. And the CEO, I'm like, how's it going? He's like, David, let me tell you, in the past couple of days, we've seen these tariffs announcements, the market's getting hammered. Let me tell you what hasn't changed. Across my desk, we've been signing deals. I know what the earnings stream looks like. We haven't cut our dividend. We're growing. But my stock price is down 30% on this news. What does that investor know across the table from me when I'm the one sitting here signing all the paperwork and I know what's going on? So something had to give there because,
Yeah,
again, a lot of these management teams can't get lost in the macro headlines that are out there every single day. You
yeah,
talk about adapting on the fly. And in this modern era of Wall Street that we're in, adapting on the fly is a tweet that hits 2 seconds ago and it pops in the market 3 seconds later, right? So, and we've
yeah,
seen that today, obviously. So
yeah,
it's very hard for us to react on a macro headline versus what
yeah.
really matters to us, I think, is fundamentals.
I agree. Yeah.
Curtis, what do you think? Go ahead.
I was going to make one response. Just one comment, just to draw on what you just said, and kind of what I said before that, which is, I think reactions that are very short term in nature and are reacting to tweets and just day to day macro headlines, like that's noise. But there is something I think quite interesting, and we went through that whole laundry list of like what is there that's changing and uncertain in the world. But like hone in on AI and hone in on office, right? Because the comments you just made, you can apply to the office REIT universe for really the last 18 months, right? I just described New York rents doubled in 9 months, and San Francisco rents are up 40 from the low at net effective, and I think they could triple. And that is AI generating net demand for space in today's economy, right? Office demand is higher because of AI. AI is positive for office today. Conclusive. There's no debate. And it's
I saw
positive.
Green's calling you, wanting to say thank you for that, by the way.
And it's concluded. And why is that? It's because there's company formation and there's significant company expansion, right? It's beyond just OpenAI and Anthropic. And so that's driving space utilization and rents up today. But the stocks were down, like pretty materially through this era, up until recent weeks, at least. Why? And it was, we apply an investor framework and a long-term approach to investing, and you've got, how do you arrive at your value? You've got your cash flows and your growth, and you've got a discount rate to discount it all back by. It's that discount rate with the uncertainty around what does AI do to the knowledge worker, to society, and to where that knowledge worker lives and works. That is the big question mark. And so I think there's noise. And I think we try to look through the noise, but there is a fundamental factor in some of these things that is that you can make sense of. Now, whether it's the right answer or not, right, is a different question. But you can make sense of some of this, the dispersion between fundamentals and performance when it's really impacting terminal value and risk.
So, Raj, you teed it up. I'm going to go ahead and put the right back on you. What sectors are impacted by AI the most?
Why don't you kick it off, Curtis, and I'll take it home.
Yeah, so I think Raj touched on some of it already, right? The most immediate impact that we're seeing is exactly what Raj said. AI is leading to more company formation, and it's not just AI businesses; it's companies that are whose formation has been enabled by AI, and in the near term, that should bolster many of our asset classes. And if you go down by market, the ones that are most exposed to tailwinds, like the SF Bay Area, which is kind of undergoing a second gold rush, if you will, is probably where the clearest opportunity is. But there's a lot of questions, right? We haven't really changed our near-term forecast very much because actually cash flow growth has been probably bolstered in the near term by AI across almost all of our sectors. But yes, the range of outcomes is certainly wider than it was, possibly good, possibly bad, relative to sort of the pre-AI moment. I think what we do
you think
know is,
are there any sectors that are agnostic to AI that it doesn't impact them at all?
yeah, there's ones that are certainly more defensive, if you want to frame it that way. So like healthcare, it's hard to see senior housing or hospitals getting disintermediated by AI, right? I mean, if anything, it might make their processes more efficient, which might maybe be beneficial. But if you think about just the larger drivers of of demographics, and factors like that, you would expect them to probably be more resilient relative to sectors that are more reliant upon growth of the knowledge worker and cognition, um, whether that be office is the poster child, but also many of the residential sectors, which historically have been job growth has been the key driver for that sector, right? And so it is fair to raise questions around whether that's going to be a net beneficiary or whether that's going to actually hurt demand in those sectors. And the real answer is like we don't know, but those are probably the sectors that you hone in on a little more in terms of the risks.
What do you got,
But
Raj? Oh, sorry.
I was going to say, what we do know is that uh, management teams are not sitting still, right? They're very highly focused on optimizing and scaling their processes with AI. And I think it's not implausible that in the future, the winners and losers in REIT land will be decided more by, which companies have the strongest platforms and technologies and processes than by which submarkets that they're concentrated in, or, are they an office company or an industrial company? And like that's been the traditional driver of dispersion. And I think there's a good chance that could change going forward. But if you step out of like the micro and take a big step back, uh, if you think that AI is going to trend the marginal cost of goods and services towards zero, and that's the goal, right? Is like AI is going to make everything so much more productive that unit cost, is going to come down. If you believe that to be true, then land, power, and tangible assets may actually become some of like the few truly scarce resources that are out there. You can't make more land, right? And so that is something that I think is worth keeping in mind as well.
You're forgetting one key resource then, if that's the case, unless you said it and I didn't hear it. What about water?
Yeah.
Nothing. Okay. Raj?
Yeah, no, I mean it's a good point. I think the water oriented kind of investment opportunities out there. It's a pretty interesting industry when you kind of dig into it. But
Think about how much water a typical data center consumes. I mean, that's the key. It's not where's the data center going to be developed. It's where's the water supply to power that data center. That's I feel like the next question that's always being asked right now is where's the water coming from?
yeah, I would say on the water. I mean, so data centers obviously are. I think you can reference say like there's a societal change occurring. I think one of the societal pushbacks which we're seeing through data opposition to data center development is ultimately an opposition to this era to AI, right? Like I think it takes the form of, hey, my power bill is going up. It is, but it's going up for a different reason. It's not going up because the data center is going up because the grid is old and inefficient and needs an upgrade. And actually, the hyperscalers would pay for it. Like they just need to be forced to pay for it, and because they've said they'd pay for it. The mechanisms just haven't been established. They will. I don't think power bills are going to go up that materially on the back of data center and AI build. The water one, and I've been kind of you mentioned Aviva, where I worked before. One of the first deals I started my career there, or it was very early in my career there, and I worked in 2005. I was involved in a data center acquisition, and I was an asset manager on that transaction. It was the biggest data center platform in the world at the time. And so I've been in and around the data center industry for over 20 years, and I think it's kind of fascinating that it's gone from where it was, which was a very niche part of everything, to such a big part of society. On water, though, it is worth just pointing out many of the modern developments you don't build a data center anymore that isn't closed loop with respect to its cooling framework. And so, yes, there is water that is used, or yeah, there's water that is used in the process, but it is not like it's a fairly contained and small amount of water that's ultimately used in modern data center functioning. And so I think there is a little misinformation out there with respect to how water intensive the data center industry is. It is incredibly power intensive. Like that is all. The data center is a glorified power socket. But the water one, I think there's some misinformation that, but it's all getting lost in the mix right now. What was it? Oh, I was just gonna add, Curtis made a comment about healthcare because you asked, hey, who's immune from AI, right? And because there's a lot of impact across the space, positive and negative. I think healthcare, it's more than just being immune to AI and having the demographic tailwinds. It's also, you look at the numbers, right? You look at the figures for care provision, and you don't just look at the demographics of the aging, you look at the demographics of the young. Pretty soon, we're going to run out of people to care for the elderly. Like, forget about how we're going to pay for it and what it's going to do to profitability and which REIT's going to win. Like, there's just not enough people. To the extent, like, robotics and AI, just because it's the word we're using today, like, to the extent that's part of the solution, that's huge, and in a good way, right? Like, because otherwise we're not going to, like, there's a real structural challenge in most countries around the world, right? Like the developed world and China. Like, so anyway, it's a hey, like there's some positives here in the AI conversation.
So I know you both cover different sectors or you have a focus. So why don't we take a look at, what sectors are jumping out at you? What particular themes resonate right now? I guess more importantly, what should somebody be thinking about if they're not already thinking about it based off of the sectors that you cover currently?
Well, I
Whoever.
can kick it off. Yeah. And I'll just touch on, you know, I think the retail sector is actually quite interesting. It's been unloved for a long time, right? And so that's one reason why I think it actually is quite misunderstood at times. Fundamentals are very solid, and ironically, a large part of that is because of the retail apocalypse that happened, 10, 15, 20 years ago, which resulted in basically no new supply being delivered at least over the last decade, if not more. And you also saw that result in weak tenants being washed out, retail formats that have been reconcepted. You saw an acceleration of figuring out omni-channel retailing, and there is so little vacancy now that tenants are now looking to fill out their space needs as far as we're hearing 2028, 2029, even 2030, because they're just looking down the pipeline and saying there's just no vacancy and there's nothing being built to address that vacancy, right? Or very little being built. And so the result is that like leasing spreads are at 20-year highs, which is a pretty good margin of safety, even if you sort of have macro headwinds that, take place. Now, I think the counter to that obviously is macro, right? The K-shaped consumer dynamic is obviously continuing to take place. Household budgets are stretched in many cases. But we're not seeing that stress show up in the real estate centric data yet. And so, we try to be data driven. It's something that we're watching very, very closely. Private capital has been very active in the space more recently, and that is noteworthy. They finally moved past sort of the PTSD that they had coming out of the retail apocalypse. And I think that private bid should provide a floor on asset values for, at least some time.
I mean, I personally do think it's a sector that's ripe for consolidation. We have a lot of publicly traded REITs that focus on the world of retail. And you wonder if the whole size and scale picture comes into play here, that some of these smaller players might be better suited working with a larger platform, but that's just my opinion. What else? Okay.
I'll offer one more. I think the apartment sector is getting a little bit more interesting. We've had the last couple of years, we were very cautious on the Sunbelt markets, and we've actually recently turned more constructive as supply continues to be taken up. And we've seen instances where pricing power can actually accelerate quite quickly once there's enough leasing. And especially if you're in a market where it's very concession heavy, and the moment you pull back concessions, that can be very, very impactful. Um, Now, there is a tendency on the part of analysts to kind of underwrite a linear sort of gradual recovery and then just mean revert at 3% growth, call it. But while we're not projecting sort of hockey stick level recoveries, I do think that is something that is interesting and worth taking a look. Broadly speaking, I think supply is likely to become increasingly constrained, right? We're back to a negative leverage environment. So development yields are not covering your going in your financing costs. And so while the last 2 to 3 years it was all about supply, that was the whole conversation. I think the next couple of years is actually going to be more about demand. And you have some puts and takes, right? I mean, the world is underhoused. Economic growth seems pretty solid, and renter affordability continues to favor renting over owning. And that's a historically attractive setup. And I think on the flip side of that, the labor markets are a little bit mixed. Um, and lower immigration is not a trivial issue. I mean, even if that cohort is not your typical listed REIT renter base, that is a pretty significant number.
What do you think of the SFR legislation? I don't know if you want to comment on any of that, but
Sure.
you're talking about the Resi story, and that's obviously going to impact the Resi story. And I'll give you my 2 cents because what do I know? We've been saying all along that REITs are not institutional investors. And so we think that they're going to be excluded from any of this pending legislation that's out there. We think it's actually good for the REITs at the end of the day.
Yeah.
This,
So the latest version of the Road to Housing Act it appears more rational, it's less restrictive, and I think that does importantly reduce some of that policy overhang that's been plaguing the sector for some time. Um, you could make an argument that there are certain forms of regulation that would almost help some of these guys. If you have a smaller player that uh, cannot scale, they can't go out and buy anything anymore, then it might make sense to just sell to one of the larger guys who have a platform, right? Or be managed by one of these larger guys. But I think the latest iteration does seem quite a bit less restrictive, which is good to see. The sector is still working through some pockets of oversupply, but the move out to buy dynamic looks less threatening in the near term because home ownership affordability remains so challenged. And I think there is an often underappreciated advantage from the SFR sector, which is that these guys can sell homes to owner occupiers at very attractive valuations, right? And why is that? It's because the decision to buy a home is often more an emotional decision than it is a purely economic decision, right? And so these companies can go out and sell their assets at cap rates in the threes and recycle that capital back into their portfolio in the sixes. So very widespread. So that's a really attractive opportunity. I think the constraint is that you can only typically do that when a home is vacant. And it's a pretty low turnover sector, right? Turnover has been going down. And so that is somewhat of a limiting factor.
okay. Last question. Anybody watching, you got questions for Raj or Curtis, feel free to put it in the chat. I'm sure you can reach out to them as well. They'll try to answer your questions to the best of their ability. Email me, I can get it in front of them. But my last question is on all the capital markets activity that we've seen recently. Look, I've been saying and we've been seeing the lending window is wide open. You want money? You got it. You can raise $1 billion in 5 hours, it seems like, for some of these REITs right now. You want to do a forward equity offering? Sold to you. Here's 6 million shares, pricing in 6 hours. Any REIT can go out and raise money right now. So we've seen IPOs, you hit on the 3, guys going private. We've seen 2 public to public mergers, actually 3 public to publics announced. We won't say who they are. You could figure it out. A lot of M&A activity, a lot of debt and equity raising. We're back, baby. Let's go. But in all seriousness, what do you think about all this capital markets activity? Where do you think the puck is going? Actually, it's World Cup. Where's the ball going down the pitch? And what do we make of all of this?
Yeah, I mean, I think it's similar to the dynamic when we were talking about like what's performed, what has the REIT sector done recently? The performance has come back up again. I think it's more of a return to regular business but equally it's occurring in an environment where there's a broader pickup in M&A activity across the economy, right, across the markets. And so it's healthy. It's a good thing. I think, I see it as a healthy and a return to the norm rather than a kind of an extraordinary period of time where, things don't make sense. Like, I think things just make sense, and it's kind of like nice to have a return to normal activity. In the same way, it's nice to have our sector, deliver positive performance, and for some of the, the strong attributes that we have to be recognized.
Curtis?
Not much to add to that, but happy to see it happening.
Last question for you guys. Both of you. What keeps you up at night these days?
For me, it's actually around like the future of our business in respect to how we operate, right? Like, intelligence is accessible in a way. I'm phrasing it incorrectly. AI is a big deal. We need to change the way we operate and adjust to these new tools. I joined the workforce in the early 2000s, and my boss at the time, half of his career was in an environment with no Excel or Office or even a personal computer, right? And I don't want to be that guy that doesn't know how to use AI. In the same way, I don't want our business and our process and our investors to suffer because we are not evolving with AI in terms of how we apply our knowledge work. And it is a fast-moving world. The technology is changing at an incredible pace. There are real regulatory and information safety and information security implications to looking to adopt or get in front of these new applications in the very early days. So it's a challenge. It's really hard. But as you track it, there is this natural fear of missing out, right? And it's that, okay, if we're not moving fast enough, are we going to get left behind? And that's kind of like one of the main topics that is top of my mind. And actually, we have a session next week that we're getting our global team together, and we're spending a third of that time together. We're spending a third of it socializing. We're spending a third of it really honed in on this topic. And okay, we have a operating model for 2026. What does it need to be in 2027? Like, it's, I think, but it is like a today versus tomorrow thing rather than a today versus in 5 years thing. So I think if you wait for too long, you will get left behind.
I'd echo something very similar. I know, probably when you asked the question, you were hoping for a real estate centric question, but the thing that I worry about the most is just, how do we maintain our edge? And, what got us here might not get us over, might not get us there. And it's not just AI, but the world is changing and the investing world is changing as well, whether it's, um, you know, passive ETF business concentrating in a lot of, taking a larger share, or whether it's, more fast money that's resulting in outsized moves in our sectors and our names. It's not something that changes probably the fundamental value of our companies, but it is something that we have to be very cognizant of as we think about how to invest the capital of our clients.
Well, Raj and Curtis, I can't thank you enough for the past hour of knowledge bombs and wisdom that you've shared with us. A lot of good stuff to digest. And I look forward to revisiting this topic with you, frankly, a year from now to see, how much held up, how much did it change, how much have you guys more embraced AI into the process, all these different things. But I think a lot of people can learn, from somebody who sits on both sides across the pond, both sides of the wall, public, private, big passive ETF platform that dominates the market and everything. Really appreciate all the wisdom that you share with us. And if there's any questions come along, I will pass it along to you. So thank you again. I really appreciate it.
Thanks, David.
Hang with me 1 second. Thanks, guys.